Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We're coming towards the end of a massive 12-year bull run here. Since that 2009 low, we broke out in 2021 above this bull market price channel that we were trading in throughout the past decade. And we now believe that we're in the final parabolic phase of the bull run. We're starting to see indicators like the S&P 500 earnings yield come down to 0% near tech bubble lows, near 1929 lows. We're going to talk about this chart in detail in this video. What does this actually mean? But one thing it does clearly show is that we're in a speculative type of environment, and speculative market environments can be dangerous, but they can also be immensely profitable if you're able to navigate them successfully. Now, in this video, we are going to focus on this recent correction, talk about what to expect next, whether we're about to see a collapse down to lower lows or whether the bottom is very, very close before resuming this bull run. Now, if you're interested in following these crazy markets with us, make sure to smash that subscribe button. And now, without further ado, let's get right into it. All right, so the chart I want to start off with very quickly here. I'm not going to dive too deep into this, but this is the NASDAQ 100. This is the sector, the technology sector has been leading this sell-off. We've had an 8% drop on the NASDAQ 100, and this is what has brought down the rest of the market. You can see on our chart here, it's coming down to a strong zone of support. This is a price channel that has acted as support throughout the entire run since September 2020. We're going to be making a detailed overview on this, on what impact the tech sector is going to have on the markets on our website on gameoftrades.net this week, but definitely be on the lookout for this. Now, I want to discuss with you guys a very, very interesting development that just occurred. This is, again, the price of the S&P 500 here. We've had this small correction, breakdown of the bullish structure. And here on this 8-hour chart, we now have divergence between the price that's making a lower low and the RSI that's making a higher low. Now, that's a bullish development. It shows you that although the price is going down, momentum is not confirming that move down. Right, we had that back here in February and March 2021. During this sell-off, you had price come down, RSI come up, and that fueled the next big run. But the most fascinating development I think is happening right now, and this is some big news we're seeing, is the daily chart is also showing divergence. Right, you can see a lower low on the price and a higher low on the RSI. And I wanted to check, when was the last time we actually saw divergence like this between the price and the RSI on the daily chart? And the answer to that question is not anywhere throughout here, not anywhere throughout this period either. The last time we saw divergence like this was on this drop right there, where we saw price come down, make a lower low, and the RSI come up, make a higher low. And that fueled a major run to that big top here. And before that, we can go back a little bit further, was back here in 2016, a lower low on the price, a higher low on the RSI that fueled a major run. Now be careful here, because if we continue to sell off, we might burn through these divergences and it won't actually mean anything. But if we manage to see a bounce off this zone of support here, that sets up the market for a major run from here, and that's the direction that we're currently leaning towards, as I'm about to show you in the rest of the developments that I'm going to cover in this video. If we take a look at the market breadth, so that's the S&P 500 percentage of stocks above their 50-day moving average, right? That takes a look at how many stocks are participating in a correction or in a rally. You can see we're oversold here, and usually we only get these readings for very brief moments in time, usually a few days before we see a big snap back up, right? Look at this. That's how the stock market works. You get breadth reading, go from oversold to overextended very quickly And that's what can trigger major market rallies. If we add the S&P 500 on this chart to actually take a look at what happened after this move up, you can see that was the October low, and that fueled the next few months of upside on the S&P 500. If we take a look at the VIX, we're also still at resistance here, right? The VIX is the volatility of the S&P 500. It tends to spike when you have market corrections. And throughout the past year and a half, ever since COVID, we've seen volatility be contained by these lines of resistance every single time. And this time is no different. We got one rejection off this level here, and now we're rejecting off that second line, which has also acted as resistance many, many times throughout this run. The sell-off in treasury bonds is also still holding, right? That's telling us that investors are getting away from safety, right? Treasury bonds is the symbol of safety. You want to be in treasury bonds if you think there's going to be a downturn, if you think default risks are elevated, if you want to protect yourself. But look at what's happening here. We're getting a rejection of that trend line telling us we're going to see money flow out of the bond market and possibly into stocks and most likely into other assets. That's why we're seeing Bitcoin absolutely take off here, breaking out. Very, very good news for anyone that's been listening to our videos over the past few weeks. So generally, we're keeping our bullish bias on the S&P 500. We think the bottom is very, very close, but here we do have, and I know I'm going to get quite a few comments highlighting this, is that there's a head and shoulder pattern here. So we need to see where we close the week and whether we can snap back above that trend line. But head and shoulder patterns like this can, once broken, lead to significant downside. So perhaps there's a little bit more to go in terms of the markets correcting before we make a full bottom. But I think any further downside is going to be retraced very, very rapidly. So the risk reward here, in my opinion, is good. And again, if you're just focusing on the technicals, if you're just paying attention to the patterns and to the trend lines, the stock market actually remains incredibly bullish as long as we hold above this line here. We broke above that in March 2021 very impulsively. This is a bull market trend line, broke above it, so it would be normal to retest it and resume in a very powerful manner. I don't like to get caught up in the day-to-day price action. I want to focus on the big trends, on those big levels that actually let you beat the markets, that actually yield higher returns than just trying to day trade that day-to-day price action, panicking on small moves. That's the time frame that we look at and that we love to research and analyze at Game of Trades. These are multi-month trades, multi-month or multi-year investments, and we focus on the general market direction quarter by quarter, not day by day, not week by week, but actually what the performance is going to be looking out the next few months and how to properly position to take advantage of those big trends. Now today we just posted, right before I started making this video, an article on the long-term bullish case for the energy sector, covering exactly why we think this is going to be an outperformer throughout the next few years. We take a look at the commodity cycle in detail, the relationship between energy stocks and crude oil prices, and what we think is going to happen with all that. Because I think that we're going to be entering a very peculiar type of environment right now where stock market returns are very likely to be low. Now, this is the 10-year return of the S&P 500, showing you we're getting to the end of that cycle. If you look at valuations, we're even more extended than that. So we're getting to the end of a bull market, and that's with one of the first big inflation breakouts that we've had in years. So we're no longer in that same environment where we've had low inflation, and we're about to enter a whole other type of environment. And I think it's going to be very challenging to find stocks and sectors that perform well. And there's only going to be a handful of sectors, only a handful of assets that actually outperform the market, that actually perform well. And there's a lot of misinformation about all this on the internet. So again, if you're looking to have a broader perspective on everything that's happening, perhaps get a few ideas on how to position for this coming environment that we're going to be seeing. Take a look at the frequent market updates we make when there's big market movements like the recent corrections we've had. I highly doubt that you're going to regret signing up to our service. We've had so many tremendous comments over the past few weeks on our content. We've really been trying to clarifying the education and clarifying our convictions. Now let's take a look at that chart that we talked about at the beginning of the video, which is the earnings yield of the S&P 500 that's coming down to tech bubble lows, also seen at major stock market peaks in history. The chart doesn't highlight this, but even 1964 here was just before a major period of stock market underperformance. And, earnings yields were particularly low here. Again, that tells you that expected returns on stocks are very, very low from current levels. But let's actually try to understand what's behind this. There's a lot of people showing this and just quickly jumping to the conclusion, oh, there's a crash that's going to come right now. And I think that's very easy to say that. Not much reflection being made based on that, because this is just the earnings yield and it doesn't take into account the monetary environment, which just hasn't been the same throughout the past 100 years. We've had extremely low rates of inflation throughout this period. So we need to take that into account when assessing indicators like this, because all this is measuring the profits of the company against the actual market value of the share. And so if you have a high inflation environment, your real profits are going to be low. And so that completely changes the picture that we have here and brings me to this chart here, which actually shows you the real earnings yield throughout the past 70 years here. And so when you actually take into account inflation, right, this is real, so it takes into account the inflation rate, that's when you can have a scale that has a zero, because it tells you that when earnings yield are below zero, it means that inflation is higher than your actual earnings yield. And that's exactly the situation we're in. We were in that situation in 2007. We were in that situation in 1999, in 1981, right before a major recession, and in 1973, right before the Nifty 50 bubble popped here. So that's a pretty worrying chart as well. Again, speaking to low returns over the next few years. But so why are stocks still going up right now? Why are we still in a rally? Why are we expecting more upside on the stock market? Isn't that completely absurd, seeing real yields being negative? Well, no. Because if you actually compare earnings yield to the treasury yield, which is the bond yield, right? The 10-year treasury bond yield, you can see that the earnings yield is still much, much higher than the bond yield. Now, why is that a very different environment to anything that we've seen throughout the past 20 years? Is because typically what we've seen is the CPI, so the inflation rate, be actually below the 10-year treasury. So, CPI and treasury yield have more or less been synonym. And so that's exactly why that chart that I showed you with the real earnings yield works so well. Because when inflation was hot, bond yields were actually high with that inflation. And so that brought down the stock market. But what we're seeing right now is that inflation is hot, right, at around 5%, but bond yields haven't risen to 5%. Bond yields are still at 1.24% because there's lots of deflationary fears, because there's QE. We have the Federal Reserve pushing bond yields lower. And so what that means is that the 10-year treasury, compared to most moments in history, is incredibly unattractive relative to inflation, right? You only get 1.24% on your yield. You only get 1.5% on your 10-year treasury compared to the 5% inflation readings that we're now. So you're in negative territory. Bonds are extremely unattractive. So yeah, real yields are negative. That's definitely not something you want to see if you own stocks. But bond yields are even more negative. So what do you do? What's the option? So that's kind of the weird environment that we're currently in, where both stocks and bonds are just incredibly unattractive investments. But bonds are even less attractive than stocks. And that's why we're bullish on stocks. We expect the stock market to continue rallying right up until you start to see that 10-year treasury here begin to catch up to the S&P 500. When you see that red line catch up to the blue line and that blue line come down as, you know, the S&P 500 goes into extreme valuations that will bring the earnings yield down, the 10-year treasury will continue rallying because of inflation. That's when you're going to start to see that bubble pop. Now, I hope all of this helped you guys. If it did, smash that like button as hard as you can. It makes the effort we put into these videos worthwhile. In the meantime, I wish you good luck on your trading and see you next time.